Still struggle with. So when we talk about second page stories, what we're trying to do is get people thinking about what's not priced into the market and what you might want to have in the back of your head. What could have some, depending on how it unfolds, could have some important market implications. On equity markets, still look cheap. That's something we said 6 months ago, something I'd still say today, and it's a relative call. It's a quirk of the equity markets that we all look at things on price to earnings basis, PE ratios. In most other asset classes, you think about value as a function of earnings divided by price. And you can do that in equities, and you get the earnings yield. And that's the same as a dividend yield, or the yield you get from owning a bond or putting your money in a bank account. Right now, interest rates everywhere are tremendously low. And in a low interest rate environment, the yield on all asset classes has got to be low. And equities don't get a free pass on that. So all it means is that when we look at PE ratios, the inverse of the yield, PE ratios have to be high. It's a truism. It doesn't mean equities are expensive. So what you need to think about when you're thinking about asset classes being cheap against one another is how they look compared to global yields and how they look primarily to bonds. And right now, the equity risk premium, or the extra yield you get relative to investing in bonds, is as high as it's been in decades. So equities are far better value than most of the other asset classes you could own. Doesn't mean equities have to go up, but I take a lot of comfort owning something in a relative sense that's much cheaper than the other assets I could own. Well, you say that we've got negative interest rates in Europe. I had a letter from our, so right now most of the governments in Europe are borrowing at negative interest rates. And that's flowed into the commercial bank rate. So Euribor in Europe is now negative. Again, never happened in Japan, never happened in the US. And there's an anecdote that I think sort of sums it up. I got a letter from our custodian 2 months ago. I'm a portfolio manager for a global fund. I transact in a whole bunch of currencies every day. And we got a letter saying that from this point in time, we would be charged interest on the cash balances in euros we had on account with them. So here in Australia, you actually still have got a lot of room to go compared to what's going on in the rest of the world.